you're good to go, Commissioner. Okay.
John, this is great.
Yes.
Looks good.
Hey, John, do the people on the phone?
Or not on the phone, on a web.
I'm sorry, if they're on their WebEx, they see the whole.
Yep, that live square, but that's what's.
Gotcha. Notice how,
Actually, so sorry, they actually see all four like that.
say that one more time.
This view, that's what they see as well. It's
Okay.
we've been playing around with zooming in, having trying to figure out what works.
We don't have it, so it's possible to do transcribe the meeting through this program.
WebEx doesn't have that embedded, no.
Where's David?
Oh, yeah, he's behind the podium now.
Oh, okay,
Yes.
okay, all right. This is a call to order of a special meeting of the Personnel, Pension, and Insurance Committee of the MDC, Tuesday, August 22nd, 2023. Mr. Secretary, do we have a quorum?
Yes, we do.
All right. Are there any public comments relative to agenda items? Once again, are there any public comments relative to agenda items? There being none, we'll move to item 3, approval of meeting minutes of July 26, 2023. Do I have a motion?
So moved.
Are there any questions, exceptions, deletions, what have you? May I have a second?
I think Commissioner Curry.
Oh, okay, all right. All those in favor? Aye.
Aye.
Opposed? Aye. Any abstentions? Good. We will now move to item 4, which is a report with regard to the second quarter investment performance with regard to both the pension and the OPEB trust.
Good evening, Mr. Chair. If I may, Bob Barron, Chief Financial Officer. I'll be
Thank you, Bob, and good afternoon, everybody. If you all can, thank you. If you all can open up page 4 for me in the MDC pension book, you might have two books. One says pension and one says OPEB. And page 4 in the upper left-hand corner will have some economic statistics. Generally, what So, are you all there? Page 4? Great. So in the upper left, the I think so. That is all. So we are at least moving. So we are still a little bit off of target, but again, the trend is positive. And finally, the last number here I want to highlight for you is the Fed funds rate. You'll see that the current Fed funds as of the book was 5%. Post this report, as you know, in July, the Fed raised interest rates again by 25 basis points. So they paused in June, they raised it again in July. This week, you may have all heard that the Fed will have a talk as well. And at that conversation, they're going to hopefully give us some insight on what's going to happen in the future. Right now, though, the markets are assuming that the Fed may raise short-term interest rates by another 25 basis points. 25 basis points, as you know, is 0.25%. What that essentially means that although it seems like inflation is being held in check, there still are a lot of challenges out there, and therefore the Fed's trying to hold back inflation while still allowing the economy to kind of chug along. So there are still a lot of challenges in the current marketplace. I didn't talk about any of the exogenous events out there. Obviously, the war in Ukraine still is a challenge because not only is it actual war, but it does affect raw materials such as grains, because as you know, Ukraine is one of the breadbaskets of the world, as well as different rare earths, which come out of Russia as well. So there are Having said that, if you look in the upper right-hand corner of the page, we have two columns of different benchmark returns. You'll see the quarter and the 12 months. I usually highlight the second row, which is the S&P 500. As you know, the S&P 500 represents roughly 500 stocks. Most of them are large stocks, so market capitalizations north of, call it, $20 billion. And for the quarter, the S&P 500 returned 8.7%. That's a big number. In fact, if you look over the trailing 12 months, now that's almost 20%. As a reminder, if you look at any 20-year period for the S&P 500, generally speaking, that return is roughly about 9%. So an annualized return of about 9% is kind of what you get over the long term for stocks. By the way, we got that in one quarter. So that's just a way of saying that we probably are a little bit over our skis. I wouldn't be surprised if we see some volatility between now and towards, let's say, the third quarter, which is why we saw a little bit of pullback in August. That's kind of a cyclicality that we do see in the stock market typically. But having said that, we'll take a good return when we can. So large cap stocks did quite well. Mid cap stocks and small cap stocks, represented by the Russell Mid Cap and Russell 2000 respectively, returned a little bit less than the S&P 500. The next two rows represent stocks outside the US. The MSCI EAFE is developed countries, large cap primarily. So countries that you all are familiar with, like the UK or France or Spain, Japan, etc. MSCI emerging markets are smaller economies. The large country there that primarily dominates that benchmark is China. But you'll notice that that actually was a little bit modest. And as you know, China has had a tough time trying to get out of its policy that they implemented after COVID. So the economic growth has been very modest. The last two are the opposite side of stocks. You have NCREIF Odyssey, which is real estate, and US Aggregate, which represents bonds, both of which had negative returns for the quarter. And actually now for the trailing 12 months, they also were negative. But that's why we have an asset allocation that we have for the portfolio. Obviously, you have pieces of the portfolio that zig while others zag. So for us, in our case, we did have a portion that did zig with the real estate and bonds, but the other portion, which was stocks, did zag. And we'll get to that in a moment as well. The last thing I'll highlight for you on this page is bottom left-hand corner of the page. You'll see that the quarter, square, growth, core, value are the columns, and then large cap, mid cap, small cap are the rows. This past quarter was truly a large cap growth dominated quarter, not dissimilar to what we've seen many a times over the past couple of years. So if you invested in a handful of names, actually it comes down to 7 names, that represented, call it 3/4 of the return that we've gotten year to date. And they're all names that you're familiar with, such as Meta, Microsoft, Tesla, NVIDIA, Apple, etc. Those are large cap growth stocks. And for the quarter, generally, large cap growths were up by 13% for one quarter, while the exact opposite, which are small cap value, they were only up 3%. So there was a definite trend that growth stocks and large stocks did well. If I could ask you to flip a couple of pages and go to page 9. So page 9 is a snapshot of the portfolio over different trailing periods. And what I'll do is I'll go through that first row on top and then come down the first column. And the way to read this is that for the quarter, the fund gained 2.4% on the gross of fee basis. It did trail our shadow index and our policy index. Remember, the shadow index is if we had our money in the asset allocation that we have currently and we just use index funds, that's what the return would have been. The policy index is if we had used the asset allocation in the investment policy using index funds, that's the return we would have gotten. So for the quarter, we did underperform a little bit at 2.4 versus the bogey. Primarily, that was because of an active large cap manager that we did terminate towards the tail end of the quarter. So on a go-forward basis, we won't have them anymore, but that was the lion's share of the underperformance. But that resulted in us ranking in the 79th percentile. So meaning that of roughly, let's say if there were 100 funds, we would have only been at 21 of those funds. However, if you look over the longer term numbers, you'll see the trailing year, the fund gained 9.8%, 31st percentile, 3 years, 8.6%, 23rd percentile, 5 years, 6.6%, 46th percentile, and for the past decade, the fund gained 8.8% on a gross of fee basis, ranking in the 2nd percentile. So over the past decade, which includes the performance numbers of all the other years and all the other quarters, the annualized return of this plan still is almost 9% every year, which puts it in the 2nd percentile. So over the long term, the asset allocation has worked. We're not going to have a perfect quarter every single time, but more often than not, the fund has done nicely. If you come down the first column, as I mentioned to you, the reason why we did have that underperformance primarily is attributable to that first asset class, large cap equity. You see large cap equity was 4.8%, while the bogey was at 8.7%. So that differential there. Midcap is an index fund for us, so you would expect that return to mirror that of the benchmark, which it did. Small cap is an active manager with Wellington. They are one of our star managers. They gained 6.1%, while the benchmark was at 5.2%. So they exceeded the benchmark nicely by almost at 1% on a gross of fee basis for the quarter. More importantly, though, if your eyes take you to the last column, over the past decade, this allocation has outperformed its bogey by over 3% annualized, almost 4% annualized, 11.9 versus 8.2 on the gross of fee basis. On the net of fee basis, they were still 11.3 versus 8.2. So even after fees, they beat the benchmark by almost 3%. The other place that we did underperform a little bit was international. That was down. That was off negative slightly, fractionally, while the benchmark was up 3.2%. This is also a place that we did make a change in the prior quarter. We terminated one of the managers, took that money and gave it to the other manager. We did better, and that manager over the long term has done better as well. Real estate had a negative quarter, but over the longer term, what I'll say is that if you look at that 5-year column, 5 years real estate was at 6.7. If your eyes take you down to the next row, also timber was at 3.5. Both real estate and timber for us act as a proxy or as a substitute for fixed income. It's going to have similar volatility over the long term, but hopefully the return streams are a little bit different and hopefully gives you a little bit more return. You'll notice that over the trailing 5 years, real estate was at 6.7, timber was at 3.5, and fixed income was at 3%. So it's been a good trade-off for us because the way that we sourced all of that money for the allocations to timber and real estate has been taking it from bonds. Asset allocation in the upper right-hand corner of the page is the snapshot at the end of the quarter. What I will say is that this is a little bit of an anomaly because the vast majority of that cash that you see on the bottom right-hand corner, if your eyes follow through each one of those rows, large cap, mid cap, small cap, all of them had roughly 10% at the end of the quarter. And then you see international about 14, real estate, timber, both at single digits, and then fixed income at 16.6%. Cash comes up as 25.2%, but really cash is closer more to about 2% because the rest of that cash is actually money that we were able to raise when we terminated one of your large cap managers. That happened at the end of the quarter, and then they actually, we invested that money at the beginning of the quarter. So right at June 30th, it was fully cash, but then it was invested once we started the second quarter. So in the next book, you will see that right itself, and the allocation to large cap, instead of being 10%, jumps up to about 33%. Bottom right-hand corner of the page, just to indicate for you that the beginning market value was $244 million and change. We had about $5 million of withdrawals, primarily to meet our pension obligations. And then income and capital gains took the portfolio back up to where we were at the beginning of the quarter. So roughly, we met all of our obligations, we treaded water, and over time, that portfolio value does appreciate. If you could go 2 slides for me, page 11. What do I mean by the portfolio value appreciating? Here is a pictorial depiction of the corpus of the fund for the past, call it 20 years. Not quite, but close. And you'll see that dark line in the middle of the page is the actual market value of the portfolio. The dotted hash line, which is kind of going up at, let's say, a 30-degree angle, that is if we had achieved the assumption rate over that period, that's what our market value would have been. And then the dotted line on the bottom of the page that kind of disappears right into the graph at 2022, that is our cash flow line. What does that all mean? When this portfolio snapshot started at the end of 2004, it was at about $121 million. Over the course of this period, we've taken out $132 million, most of which, of course, was used to pay off all the pensions. Having said that, we were still able to generate over $250 million, and that's why the market value appreciated from the beginning value of 121 to where it is today to about $245 million. So it's done nicely over this period without taking a ton of risk. You'll see that the curve is not smooth as one would expect. There are peaks and there are troughs, but the takeaway is that it does go into the northeast over time. Let me pause there for a second because I know I've been going through several slides pretty quickly, and some of these slides are new for some of you all. So I'm happy to address any questions that you might have before I move on.
Are there any questions?
Okay. The last slide I'll touch on is probably page 12. Page 12 is a decomposition of what we saw a moment ago on page 9. And what it does is it puts names to the asset classes, and it also breaks out for us the managers that we have, primarily in real estate. So you'll see here, at least right now, for large cap, we have Wellington listed. This is one of the managers that we actually terminated. That it will no longer be in your future books. All of that money went into an index fund. You see that over the long term, Wellington has done relatively similar to the benchmark, a little bit ahead of it, which is nice. But what we want to do is ensure that we had a cheap form of access to beta, or what the market was going to give us, which is why we got rid of Wellington. We also got rid of another piece, and we put that into an index fund as well. Rumline is our mid-cap index provider. Wellington also is our active small-cap manager. And you see by the rankings for the quarter as well as longer term, they've done a nice job of outperforming its bogey. Hardman Johnston is our remaining international manager, which did have a bad quarter. However, over the longer term, which we capture inception to date in the later portion of the report, they have outperformed. The trailing 3 years, though, is a tough snapshot for them. They are a concentrated growth manager, which still has done nicely over the longer term. And then we have 4 bites at the apple for real estate, different flavors. Cornerstone, Intercontinental, Madison 3, Madison 5. Cornerstone is a tail end fund. At this point, it's only a very modest amount of money, and therefore the performance numbers are a little bit challenged. But in terms of actual dollars, we're looking at less than $23,000 on a $245 million plan. Having said that, it still is a holding, and therefore it gets equal billing, and that's why the number looks a little bit challenged, because when these type of funds dwindle down, usually it's the last piece of real estate that hasn't done well that they're still trying to sell off, and that's why the return is soft there. But it has done well in terms of actual dollars that we invested into it. It's returned roughly about 10% dollar to dollar over the longer term. FIA is the timber manager, and then for fixed income, we have 2 bites at the apple there. We have Goodwin, which is more of a core equity, a core fixed income type of manager, while Aetna is more of a steady Eddie type of manager in return. And you'll see that over the long term, both of them have exceeded their bogey. For Goodwin, 1.3 relative to 0.8, while Aetna is at 5.7 versus 2.2. So let me stop there, see if there are any questions.
Okay, yes?
Maybe you can answer this or not, I'm not sure. We're looking at more S&P 500 since the last couple of meetings, going more towards that index fund. And based on, it's like 5 or 6 stocks that overwhelm the whole fund. Basically, it's the whole fund. And they're supposed to readjust quarterly. I've never gotten a good answer from anybody. Maybe you're smarter than other people, but I've never seen it be readjusted. What happens if they do readjust it so those 5 or 6 stocks now have an equal share? Does the index go way down?
Yes, the index weight does go down for them. What happens is that they actually, when they make the adjustment, all of the stocks that go into the benchmark are adjusted up or down based on.
Have you seen an adjustment yet?
So it happens annually. So yes, so you do see the adjustment. The challenge is you're absolutely right. Right now we're in a compressed state where, again, roughly about 7 stocks, most of them technology oriented, have been pushing the benchmark. In fact, if you look at it, because some of those stocks that are technology oriented don't fall in technology anymore, like Amazon doesn't fall into it, Netflix doesn't fall into it, etc. We are actually at the highest level of technology that we've been ever, even higher than we were in 2000. But what you are starting to see is that there is a little bit of broadening out of other sectors that have been doing better. For instance, you had biotech that's done a little bit better. Healthcare does a little better. So value stocks have been coming a little bit more into favor. Having said that, though, the S&P 500 is a reasonable measure of what the overall stock market will do. At some times, though, you will get that compression.
What do you think may happen January 1st if now we get those 6 stocks now smoothed out, and now we're back to all, I want to say the lousy ones, but the other 495 that are just marginal returns.
Right.
And I like the S&P 500, I'm not against it, it's just,
Right.
see the long run.
Well, that's why, so year to date, the S&P 500 has returned roughly about 16%, give or take. That's probably a little bit higher than what we would expect it to do. So I wouldn't be surprised if we actually lose a little bit from there, or just kind of move around from there. Right now, expectations for next year actually are for high single digits on the S&P 500, which is reasonable considering that the longer term numbers for the S&P 500 are kind of in that realm. So short answer is we expect to actually come down. But that's what the benchmark is. We're not going to be perfect market timers, but what I can say is that stocks over the long term should do okay. If you have a portfolio that has more stocks in different buckets and you combine it, that should do well.
You adjust that yearly though? For some reason I thought it was quarterly, but yearly.
So it depends on the benchmark. But S&P, yeah. So the thing that's a little bit different about the S&P 500 is that you actually have a group of people that make that decision, including using different criteria. While let's say the Russell 1000 or the Russell 2000, all those are just based on different criteria. That's it. There's no human judgment at all. So that's why for the S&P 500, although it's primarily large cap oriented, you do have stocks in there that are still mid cap and sometimes small cap. But it is the most accepted broad-based measure of stocks. So it's very reasonable. Yes.
David, could you, for those people who haven't been sitting in on the investment subcommittee meetings, could you basically cover in a general sense what our sort of general overall strategy has been and what your views are in terms of how well you think it has worked?
Sure. If I could ask you to flip to page 8 for me. So this is the asset allocation of the plan at a high level. And what I like you to do is if you add up the numbers for the target allocations for anything that's stock oriented. So we start at the top. The first line is the S&P 500 represented by Fidelity. That's 30%. Then we have mid cap, which is another 10%. Then we have small cap with Wellington at another 10%. And then we have Hardman Johnston, which is international at 12.5%. So 30, 40, 50, 62.5%. At a high level, you're looking at 62.5% stocks, 37.5% bonds, or surrogates for bonds, because you'll see that roughly 10% is real estate, 5% is timber, and then the 22.5% is bonds. So at a high level, you're looking at roughly 62.5% stocks, 37.5% bonds. It's not an overly aggressive portfolio. It is well diversified because for stocks, you have different market capitalizations, domestic and international. For bonds, you have actual bonds separated out into two ways, one of which is a guaranteed investment contract that gives you a nice solid middle single digit type of return, and the other one is more broad-based bond exposure. And then we have surrogates for bonds with real estate and timber, which over the long term have similar volatility, but again, different return streams from bonds. So the portfolio structure is not really trying to get home runs or triples. Maybe we get lucky and we get doubles, but we're just trying to hit singles because the portfolio currently has an assumption rate of 6 3/4, which is a modest type of number. And as a reminder, already year to date, the portfolio actually on a gross fee basis already has that number. And over the past, call it decade, the portfolio has generated almost 9% on a gross fee basis, 8.3% on a net fee basis. So without taking a ton of risk, we've been able to do quite well with the portfolio's asset allocation.
Any more questions with regards to the pension plan?
I'd just like to mention that as of July, the portfolio is at $250 million. For 1 month, the portfolio gained 3%. Having said that, in August, month to date, we gave half of that right back. So there is still some volatility, and again, I wouldn't be surprised if in August we continue to see some of that volatility.
Do you think next year you'll be moving more into bonds, or you think this mix is gonna be where you're gonna be at? Assuming interest rates kind of maybe start.
Yes, so that's the big assumption, right? And that's the challenge that a lot of our clients are facing. Because if you look at where interest rates are, obviously the short end of the interest rate curve is higher than the longer end, which is called the inverted yield curve. An inverted yield curve presages 10 out of 8 recessions. So it gets it right, but it always gets that it's going to go into a recession. We haven't gone into a recession yet. Perhaps the Fed has engineered us into a soft landing. Don't know. But if it makes sense for us to move more money into bonds, that's definitely what we'll be doing. What we have been doing incrementally is whenever we've needed money, we've taken the money from places that we've been over allocated, which is primarily stocks. And that's helped us come back to target. As you make money, I know it sounds counterintuitive. Why would you take money away from something that's doing well? Because the whole point of the asset allocation is for us to be non-emotional. What you want is you want an objective target that over the long term should try to get you good returns. In order for that to be effective, you need to implement it by taking out money from places that do well and then putting it into places that isn't doing quite as well, or if you need cash flow. So we've been taking the money from stocks. We've been leaving bonds where they are. If on a go-forward basis, it looks like bonds will be more attractive, we will put more money to bonds. Along those lines, just so you all are familiar with this, because I think it's something that most people would not be, because frankly, it's no longer offered. But the Aetna product that we have currently right now is not being written anymore. So we can't give more money to that even if we wanted to. The reason why I bring that up is because if you saw the long-term numbers being high 5 type of number, the question we would ask is why couldn't we give them more money? Unfortunately, we can't. So that's why we have to try to massage around that as best as possible by putting in other pieces.
Once again, any more questions for David with regard to the pension plan? If not, why don't we move to B, David, which is the OPEB trust?
Great. If I could ask you to flip to the other book. And this book, if you could all turn to page 6. It's a thinner book. It'll say MDC OPEB on the front. The numbers are going to seem quite different, and that's simply because for this plan, we have a little bit less money, but we've actively decided to take a little bit more risk here because we know that more money will be coming in at some point. For the OPEB plan, you see that for the most recent quarter, the fund gained 6%. Year-to-date, 12.7, 1 year, 11.3, and since March of 2021, so just a little over 2 years, annualized has gained 2.9%. All of those numbers are top quartile, if not top percentile. In this case, you see the net fee numbers also. You'll see that the net fee is very close, and that's because the vast majority of these assets are also indexed. Large cap here is fully indexed, came in at 8.9%. And you see that fixed income also is indexed, and that matched the benchmark at off fractionally. Upper right-hand corner of the page, roughly 72% or about 70% of the assets were large cap, and then the remainder was either in fixed income or cash. So this is a portfolio that really has allowed stocks to push it forward. We started the portfolio off at $6.4 million at the beginning of the quarter, and primarily because capital gains grew to $6.8 million. Next page shows that we are a little bit above target here. Our target here is 65-35, and that's simply because we do expect some more cash to be put into this plan, at which point we will be changing the asset allocation around a little bit. But until that point in time, we have allowed equities to increase the value here. Still within guidelines though. And then page 8 is the pictorial depiction of the portfolio. You'll see here we did have a cash infusion, a dramatic cash infusion, because when we started the portfolio here, it was less than $1 million, but more than $5 million was contributed. On that money, we made about $500,000. So that's why we were at $6.8 million. So the history is a little bit shorter on this, and therefore you can't really see how the asset allocation is doing over the long term. Obviously, it's been more equity heavy. Stocks have done quite well, which is why the portfolio performance has been very strong. Similarly, for the OPEB plan, for 1 month, we did gain 2.4%, took the portfolio up to about $7 million. Since then, obviously, we lost a little bit, so we're back down to roughly about $6.9 million. But the OPEB plan is a lot easier to explain. Any questions?
Where are you putting the fixed income?
It's an index fund.
It's an index fund, for fixed income index fund.
For this plan, yes. But we will change it once more money comes in. Initially, the reason why we did that was we started off with less than $1 million. So we wanted to diversify it reasonably cheaply. So all we did was we indexed it with Vanguard for large cap stocks, and well, primarily large cap stocks, and then also with bonds.
What are you getting, 5%? Are you getting that much on that or not really?
Well, over the long term, you should. The reason why I phrase it that way is because if you look at bonds, for the past couple of years, obviously it hasn't been very good. Yeah, it's been negative, but that's what bonds have done.
Okay, so you consider bonds as fixed income? Not T?
Absolutely. Well, so fixed income is just another fancy way of saying bonds. And for the benchmark, which is the aggregate, it includes lots of different bonds. The vast majority of them are going to be treasury bonds, whether it's bills, notes, or bonds. And then you also have a lot of agencies, whether it be Fannie Mac, Freddie Mac, et cetera. That in total is probably going to be about 40% of the benchmark. Then you have corporate bonds, which is going to represent about another 20%. And then the other pieces, which are asset-backed securities.
You fix checks every month, but the value keeps going up and down. That's basically.
We get fixed interest checks, absolutely, but the underlying value keeps going up and down. But again, the reason why we made the decision to at least have stocks and bonds is that it's a reasonable allocation to be diversified, and the easiest way to do it is just indexing stocks and bonds. And any other questions?
I'm just about to ask that. Does anyone have any other questions with regard to the OPEB trust? Bob, could I just ask you for the moment, for those of us, you'll notice here that with regard to the numbers, that there are no outflows indicated there. In other words, it's just the corpus and then there's income. Is that because basically we are making payments to retirees as we go along out of operating?
Actually, what David's reporting on is just the investment piece of our total OPEB fund. We have that cash balance that we've all talked about at Webster Bank that's actually paying the bills. David alluded to the fact that a couple meetings ago you approved a more pension-like allocation, not this simple 70-30 that we have now, but a more pension-like, because we're going to be moving money over and it'll probably hit in the fourth quarter. So when we do the fourth quarter report in February, you'll see north of $10 million worth of assets. And we'll be doing our level best to get it in more of a diversified portfolio. So the shorter answer is The withdrawals are coming from the cash account, but David's only presented what we have in investment currently. Okay. Right?
Yes.
Good.
We're on the same page.
So David has a flight to catch, so not to cut the committee short, but if you have any other questions, he's here. Otherwise, I'll do a quick introduction to our Milliman friends.
Does anyone have any more questions for David, please?
Thank you, Dave.
Thanks, David.
Thank you all.
Yeah.
Appreciate it.
Thanks so much.
Safe travel.
I'll be here for 15 minutes.
Oh, really? Oh, okay, wonderful. So this next presentation is kind of fun, and I think I think it is a you're going to see it to and when your liability goes up, so that it was and what and we are going to last year we were at 6 3/4, like David had said. I was not and so thank you.
I'm glad Bob thinks this is fun. Bob is clearly trying to earn his junior actuary badge, which I know a few of you are interested in as well. We do have two handouts. I have a couple extra paper copies if anyone needs them. But let's first, before we go into the numbers, let's talk about where in our recommendation to not further reduce the interest rate assumption. each year we take a look at your target asset allocation. Milliman's investment consultants put together a set of capital market assumptions. David goes through this exercise too independently, where we look at the expected returns, long-term returns on each of the asset classes that you're invested in. And we use that information to advise you on where we see long-term returns. Now, I short term, and neither do any of us. And I don't doing this exercise at what I think things will be in the next 5 or even 10 years. We're looking at the very long time horizon of the lifetime of these plans, which is measured in decades. So we're looking out at a very long-term horizon. When we did that analysis at the beginning of 2021, what it told us was that the expected returns for your pension portfolio were south of 6%. It was based on market conditions then and where people were looking at the tea leaves then and what inflation was then, most importantly, what inflation was then. And that's a number since the turn of the century. 20 years ago, this portfolio, everyone would comfortably have assumed that this portfolio was going to earn 8.25 or 8.5. But 20 years, 23 years, well, let's talk 20 years through, take us to, say, before the war in Ukraine started. The most economic trend was inflation dropping and dropping and dropping, and with it, lots of market interest rates, mortgage rates, rates on the 10-year T-bill, all kept sliding downward and downward. And expect any portfolio of investments to earn, because inflation is a fundamental building block, part of the investment returns. So as inflation was dropping, so were our long-term expectations about future investment returns. We got down, our low point for this portfolio was at the beginning of 2021, where our number was 5.86%. The biggest thing that's happened since then, in terms of what impacts our analysis, is that inflation has skyrocketed. It's been the past 20 years. Mid-double digit, more interest rates were higher, but kids these days have no idea that inflation ever was higher than 2%. We get a higher number now, a significantly higher number. At the beginning of 2021, it had jumped up from 5.86 to 6.42. And at the beginning of this year, it was over 7%. You may recall that the Fed and other pundits got in trouble for using the term transitory when they were talking about inflation. There was a big uproar about saying that inflation was going to be transitory, but from a pension actuary's point of view, it's a blink of an eye what's happened since the war in Ukraine started. And when we look long term, we do believe that the Fed's policy will bring inflation under control and that things will settle down. And our short-term result of this metric that's north of 7% will go down somewhat. But, and I don't think anyone knows, is where things will settle out once they settle out. We don't know when things will settle down. We don't know what the new normal will look like. In terms of inflation, or higher levels of inflation. And until we do know, My recommendation to you is to make no change, not to go up because this year's metric says 7.07%, not to go down because that was our plan 2 years ago, but to stay pat until a new normal. I'm not sure by the time we get to this time next year that we will know. So next year, we may well be coming back and again saying, hold fast to where you are. But for what the new normal will look like. So my recommendation to you is to make no change. We're just going to hold. So that's a really important part. It is, as Bob said, good news relative to continuing your plan of continuing to decrease the discount rate. I don't think you should go down. I don't think you should go up.
If I may, Mr. Chairman. Becky, last year, so just a reminder for everyone, we used to follow this process with Becky in late October. We had already set the budget. We're guesstimating what our pension contribution is going to be. Then we get a report from Becky, and now we have to modify the report. So that's why we're having this in August. But last year, correct me if I'm wrong, we actually did not have to make a contribution because we reduced the discount rate, and by reducing the discount rate, we actually got credit, and therefore we didn't have to make a significant payment. Is that correct? I think you are maybe misremembering or thinking about OPEB rather than pension. I'm sorry. So
you've made pension contributions.
Okay, so on the OPEB side, we reduced the discount rate and we saved money by not making a pension.
With OPEB was complicated, and we'll from last year. But so any questions or concerns about our recommendation to leave the discount rate unchanged at 6.625%?
Greg? I don't have a real problem with it, except you said you don't know what we're doing now, we don't know in the future, and we're still got a $70 million hole. I'm not sure why you still wouldn't keep bringing it down.
The recommendation about the discount rate is independent of how well or poorly funded the plan is. We're looking at the expected long-term returns on the portfolio, and we'd have exactly the same analysis whether you had, a surplus, a deficit, or anything in between.
Calculate your future liabilities based on a discount rate?
Yes.
So you still got $70 million future liabilities, which you have really no idea if that's a good number. So why wouldn't you just keep inching that down a little bit? I'm not sure why you're stopping.
Our recommendation is not based on on the size of the liability or the size of the assets or the relationship of them. It's purely looking at the expected returns of the portfolio. And we just think it's premature to conclude that inflation will be low like it was 2 years ago or somewhat higher. It seems unlikely that inflation will continue where it is right now, but we don't know where it will end up.
I'm okay, but I'm just thinking a little different, that's all. I just see a discount rate, you're calculating your future liabilities, and your future liabilities are still $70 million, which is, again, it's kind of a fake number, but you're, based on the 6% discount rate. So I would think you should still be bringing it down, but you know what you're doing. I'm just kind of, okay. I'm just listening. Okay.
Mr. Chairman, before we leave this pension analysis and go to OPEB, I would like to point out the very bottom dollar figure. We're going to be entering budget discussions, believe it or not, really soon. And so you'll see in the first column, we put $8,664,000 into the plan this year. So with this new assumption for 2023, they're recommending that we put $9,038,000. It is a $173,000 increase only. In the past, we've seen that number go up by millions, and so that is a very good budget relief for 2024. And you'll see something similar in OPEB coming up.
And we're not gonna let the cat out of the bag, but our budget's gonna be extremely positive this year, so I won't even say it might be zero, but it's gonna be pretty close.
Well, let me walk you,
If I may, just a quick comment, kind of building on the previous commissioner who spoke. I feel like what percentage funded is the overall pension plan at the moment? I mean, we have a substantial unfunded liability. I mean, I understand the argument just made about, you know, the metric here being calculated based off of, you know, recent inflation rates that we're seeing and whatnot. But as a practical matter, the function of shifting the discount rate determines whether or not we'll be putting more or less money into the plan. And if we have a substantially underfunded pension plan and we have a positive budget outlook in the year ahead, would it not make sense for us to seriously consider making an additional contribution to the pension plan in order to increase and improve how well it's funded?
That's a great question, and why don't I walk you now through the numbers, and if you want to put the summary back up on the screen, I'll walk you through the numbers. There we go. Okay, and it's great to have it expanded like that. So, and I'll just cue you to scroll down. So we have two columns of numbers here. The first column on the left side is last year's numbers for comparison, and then the right-hand side is this year's numbers for comparison.
2023.
There we go.
Not 33.
So you could see that the liability has increased just a little bit from 323 million and change to 329 million and change. Now we expect liability to go up from one year to the next. So that was very much in line with what we were expecting to see. The liability was the very quiet part of this whole picture. The really noisy part was, of course, the investment return. And although things are looking much better now, thank you, David, we like to hear that good news. But if you recall the results through the end of last year, for the year, the assets had a negative 14% return. 6.625%. That translates into a loss of $57 million. So the investments underperformed by $57 million relative to the assumed 6.625%. Now, so the prior 3 years together were $58 million in gains. So you lost 57 million of it last year. The market giveth, the market taketh away. This is exactly why we use an asset smoothing technique that gradually reflects any gains or losses over a 5-year period. So when we report to you on how well funded the plan is and give you our recommendation about what to contribute to the plan, it doesn't bounce up and down just because the assets bounce down and up. The actuarial value of assets, you'll see on the second line here, is that smoothed amount. At the end of last year, the market stood at 231 million, but the actuarial value was almost 254. That's because most of last year's loss doesn't get reflected right away in the actuarial value of assets. That 57 million loss, we've recognized 1/5 of it now, and the other 4/5 will gradually get recognized over the next 4 years. And those $58 million worth of gains that you had in the prior 3 years, those are still flowing through and will continue to flow through for another couple of years. So the actuarial values was nice and steady. In fact, as a dollar amount, it actually went up from a year ago. It's now just under 254. So that's why we do the asset smoothing, is times like these. So the unfunded accrued liability, the dollar difference between assets and liabilities, only modestly increased. So even though you lost 57 million on a market value basis, the unfunded accrued liability just inched up by $1.5 million, call it. And the funded ratio, so the ratio of assets to liabilities, went from 77.2% just to 77.1%. So when we measure the plan's funded status for purposes of determining your contribution, it was quiet because that asset smoothing dampened that impact of the market fluctuations. So actuarially determined contribution, if 100% funded over a period of years, we're down to a 16-year period. That payment amount is called the past service cost. So think of it as you've got 16 years remaining on a mortgage with payments that by design go up by 3.5% per year. You'll see the amortization growth rate is 3.5%. So service costs to grow by 3.5%. If expected, there were, of course, we didn't ignore so goes through. So the past service cost has gone up about $400,000. The next big component of the contribution is normal cost. The total normal cost is the cost of benefits being earned this year by your active employees who are covered by the plan. So they work a year's worth of benefits. The normal cost is the value in today's dollars of that extra benefit they earned. They into the pension plan. They contribute a portion of their paycheck to help fund their pension benefits. So their expected employee contributions, we subtract from the total. And then we add in an expectation of administrative expenses that you pay out of plans assets. And when you take the total normal cost, subtract the expected employee contributions, and then add in the expected administrative expenses, we call the result the net normal cost. And you can see that it's actually gone down a little bit from last year. That's because your head count has gone down. You had 418 active members at January 22, and you were down to 399 at January 23, which is a pattern you've been telling me you've expected to see. We had more. That's more than we expected, and also 16 terminations. That is, someone has terminated employment, but they have not yet either have chosen not to retire. And both of those numbers are higher than we expected. So more turnover and more retirement activity than we expected, so that your head count has dropped. Well, normal cost and employee contributions reflect how many active members you have. So your head count went down, the normal cost went down as well. So you actually have a little reduction that ties right back to your head count going down. And then the last and smallest piece of the contribution is interest. We prepare all of these calculations as of each January 1st to inform you on what to budget for the following fiscal year. So this is a January 2023 valuation, but it's being used to determine the contribution for fiscal year 2024. So we add a year's worth of interest to reflect that timing lag between when we calculate the numbers and when you pay them. So the sum of those three things that you'll see in bold, the past service cost, the net normal cost plus the interest, equals the actuarially determined contribution. And as Bob said, it's gone up from $8,664,000 to $9,038,000. Questions on any or all of that?
Thank you, Mr. Chair.
So I think I just have, this is Commissioner Desai.
In past years, you've presented to this committee alternatives. And all I see is one proposal. Do you have a page that would show what our contributions would be if we continued with that baby step for next year?
We did calculate what these numbers would look like if you reduce the interest rate assumption to 6.5, but that is not our recommendation, so we didn't include it on this page. Our recommendation is to make no change.
Would you be provided with that page?
Bob, do you have off the,
I think I can find it real quick.
yeah, or I have it in my briefcase on my laptop. It in the contribution.
How does it affect the percent funded?
So assumption, it increases the liability, it increases the total normal cost, it increases the contribution. So if is 76 or 75% funded, and ballpark, I'm just from top of my head, the contribution would maybe go up by 100 or 150 or $200,000. To a comment that was made before, I make a policy of never trying to talk my clients out of putting more money into the pension plan than the actuarially determined contribution. That's a fine idea under any circumstances, but you know your bigger financial picture much better than I do.
So, if I may, Mr. Chairman, we, as you know, we start at staff budgeting in July. We're planning in July. We're working on budget in July and August. And we will be coming to Board of Finance and coming back to the full board and talking about the budget. And we're very happy where we are. And with water sales have been great. Our sewage sludge has been great. We've been very favorable on overtime and employment. We've been very favorable on gas and those kinds of things. So there will be some opportunity during the budget process to make those kinds of decisions. And I talked to the chairman about this. If we are favorable on the water side, I do want to ask Board of Finance and the board to consider, last year we gave back 28 cents. We lowered the water rate by 28 cents. We are going to be presenting the second half of our water master plan to the Water Bureau on the 30th, I believe. And if we have some favorable, what we're going to propose is to, rather than give back money, whatever that is, 5 cents, 10 cents, whatever that might be, that maybe we start to develop, like we have in the Clean Water Project, which is a rate stabilization fund, because the plan for the water master plan is to spend $400 million over 30 years. And we'll be spending $400 million without one bit of revenue. That's just pure infrastructure improvements and replacements. So there'll be a lot of discussion, Commissioner, to your point about, do we, in the budget process, does it make sense to go back and lower the discount rate because we're favorable on the budget side, and does it make sense to lower that discount rate?
Well, if I may, and I tend to agree with Commissioner Stuber. We as a committee, we're only involved at this point because we haven't gotten to the budget aspect yet, but we're only concerned about the health and welfare of the plant. And putting all the other information aside on what Scott said, and I know what Becky has presented, but we're not given the alternative of continuing those baby steps that is what our plan is. So I would ask that, and I don't need it now, Becky or Bob, but if you can put this page together.
But Bob was able to pull up that number, which I had shared with him previously, and it was the contribution at 6.5% is
Just to emphasize what Becky said, this is a long-term liability that requires a long-term plan to fund. And the question earlier was, hey, if we're having a good year, why don't we put more money in? Well, our whole goal is to appropriately increase our contributions as necessary. And that actuarially determined contribution, the ADAC payment, will put us at 100% funding over 16 years. And just the same as we're having a good year, if we have a horrible year, that increase, as long as we fund the ADAC in its entirety, will be moderated. And that's our recommendation. And that's why we pay Milliman, is to give us an appropriate recommendation for a contribution that will ensure that the assets are available when the liabilities come due. And you'll notice that every year, I think we started out at 28 years, but now if you looked at that 2022 column, we were amortizing that unfunded liability over 17 years. Well, next year we're amortizing that over 16 years, and then it'll drop a year. So I would just ask that you consider, is the reason we engage them is because they allow us to moderate our contributions to these plans to ensure that the assets are available when the liabilities come due. So we'll certainly do whatever you recommend. If you think we can afford another $300,000, we can lower the discount rate and make that contribution. But I just wanted to emphasize those points.
My point is to the committee that, and I don't disagree with what you just said, Bob. And I know we can't take $300 out of your salary. And I don't disagree with what Becky said. But this committee, or the subcommittee at the time, approved that long-term plan for those baby steps. And while Becky's recommending no baby step, we at the very least should see what that baby step would have been or could be if we decide that that's what we want to do.
I'd like to throw out for your consideration an alternative to contemplate. I think it's important for the actuarial assumptions to be our best current thinking. And on that basis, my recommendation to you is staying at 6.625. But that you could consider modifying. And in particular, the amortization growth rate at 3.5% could be reduced somewhat. And that will moderate the rate of future increases in the contribution. So low contribution, but then slow the rate of increases in the future. So plan, but it isn't changing that key interest rate assumption. It's changing your plan for paying off that unfunded accrued liability over the next 16 years. That will grow at a slower rate. And that will have, I think, beneficial budgetary ramifications in those future years where this bid won't go up quite as fast. So something for you to consider as you think about your budget. It really is a financing question. It's not our opinion about the future. It's financing. It's thinking about how much of future contribution increases fit within your bigger financial picture. So something to think about, and we can run numbers for you if and when you want to pursue that.
If you could run those, Becky, for us, so that when we have our first finance meeting, we'll have those numbers. We know what the number is. Worst case scenario, it's 9.3 million, right?
Mm-hmm.
Best case, it's 9 million.
Mm-hmm. And,
so
yeah.
It's $300,000. We're going to be in a very good place this year. There's a lot of other considerations besides this that we're going to be asking the board to think about. And so, but we'll be more than happy to entertain that during the Board of Finance and the board meetings.
Okay, well, Bob, we'll get a range of numbers for you.
Thank you.
Excuse me,
Well, and we'll give you the formula
very
in
good.
Excel.
Excuse me, Commissioner Desai, did you have a comment that you wish to make?
Yeah, thank you, Chair. I was of the same opinion of why not paying more towards the debt, right? And understanding, it goes up and down over the years and you're trying to stabilize. But I think when you have, when you're talking about surplus and when we know there's a debt, the more money there is as the market returns fluctuate, it's going to be benefiting in a longer run. So I think it's good to I think we need options, right, rather than just one solution and say this is the best that we think is good for you. I think we have to get some options and see and maybe the board makes a decision what's better option. So, thank you.
Anyone else? Do you have any comments, buddy?
I know that there's another meeting that's supposed to start already, so we don't really get to the OPEB, the details of the OPEB. So my questions were, and I don't want to hold up the other meeting, so we have to find some way to get this back together. But the funded ratio on the OPEB fund dropped. And, I would say significantly. So, 4% when we're talking about 13%. And then the other question is they have was that, so we experienced a drop in employment from total employment from 418 to 399. But we had, for the first time, I think, I could be wrong, but a significant number of terminations, not retirements. And, I don't know if anybody here thinks that number is going any lower than 399, but if it does, I think it's going to be a challenge to keep going, especially with the programs that we just started up with, particularly, the work here in Hartford with the flood problems and everything. So I know, and I agree that Milliman has provided us with a plan that I think both of you have said, is about the health and welfare of the fund. And I think that that doesn't change. The year-to-year issues with our budget are something other than that. And so we have to get to that, I think. And we haven't started the budget hearings yet, and I don't. But we will be soon. But I would like to, at some point in the future, get through the same analysis on OPEB that we did with the retirement. And I just. Mr. Chairman, I just don't want to extend it any longer because there's another committee that's supposed to be meeting at 4, so I don't want to drag that out. So.
Becky, if I may, Becky, if you could just clarify, this question came up before too, just to clarify, having more employees or less employees still costs the MDC more money, right?
Yes.
Can you explain that?
Yes. If you look, the total normal cost is a much bigger number than what the employees are contributing, right? So what the employees contribute does not come anywhere close to covering the full cost of their pension and OPEB benefits. So every employee that works here that's covered by the pension plan costs you money every year. I can just very quickly remind you of why the OPEB funded ratio dropped. And I know if you have another meeting, but I can give you the 30-second overview of the OPEB numbers. We only do full valuations for the OPEB plan in even-numbered years, so this is just an update based on the 2022 valuation, but reflecting what actually happened to the OPEB assets during 2022. And the most important thing you may recall from our meeting last year is that Bob and his staff were able to finally really get to the bottom of exactly how much is being paid each year in retiree medical benefits, teasing out retirees from active costs. And as a result of that process, you voted to make a corrective payment out of the OPEB assets of $7.2 million to repay amounts that had erroneously been paid when they didn't have the correct measure of benefit payments. So, million because of that action. So the funded ratio, but you knew that that was going to happen when you decided to do that. So the assets dropped, and we've reflected that. The employees also, you can see the expected employee contributions have gone from 434,000 to zero, because it's our understanding that as of this year, employees are no longer contributing 1% of pay towards the OPEB benefits. So in the OPEB contribution going up last year from 7.867 million to 8.507, let's call it. So it's a $640,000 increase in the OPEB contribution. Again, with no change to the 6.625% interest rate.
What is the overall funded ratio for the OPEB plan?
So OPEB is now at 9.1% at the beginning of 2023. And you only started funding it 2020. So too long ago.
Curry?
A quick yes or no response is good with me. Our friends in Wall Street, our rating agencies, are they going to be okay with no decrease in discount rate?
Yes, and I'll just repeat what I've said before, is that they want to know that you've developed a plan and you exercise that plan. That's why it gets me a little nervous when you say, hey, let's put more this year, but maybe the subsequent year we can't afford that more and we drop down. It makes it very hard for me to explain to them why we're going up and down. It's very easy to explain on a given set of assumptions to the professionals that analyze what it takes to fund this appropriately, that we do 100% of the ADEC every year. And so that's what I think they look for. You have a plan, you execute it, and you're fully funding your ADEC. And that's what the recommendation is for both plans.
And all of your member towns that we work for, which is most of them, we're making exactly the same recommendation.
And the ones I'm aware of agreed with that recommendation.
Any other questions for? Thank you.
Okay, great seeing you all.
Thank you, Becky.
Thanks, Becky.
Yes, we do. We don't have to take any official action. Opportunity for general public comments. Once again, opportunity for general public comments. Commissioner requests for future agenda items. There being none, I will entertain the appropriate motion. Adjourned.